School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 5 Emerging Issues in Accounting, Unit 16 Forensic Accounting, Part 3.
Other financial reporting schemes. Fraudulent audit confirmation. Audit confirmation gives assurance to the stakeholder regarding the authenticity of financial statements. However, a large part of the audit confirmation is based on the records and information provided by the company, even in case of sales, cash, accounts receivables, debt and liabilities, where third-party confirmation is obtained by the auditor and is not an assurance that factual information will be provided by third parties, as they may act in collusion with the company. Refreshed receivables. As a prudent practice, companies need to make provisions for bad and doubtful receivables, that is, debts owed to them, but in order to avoid making provisions and write-offs, which decreases profits, companies refresh the aging or old receivables and improperly represent them as receivables which are current in nature. This scheme operates by crediting the receivable account of the customer and allowed to repurchase goods on credit. In this scheme, no physical transfer of goods take place. Other methods used in the schemes are modification of dates of invoices in the account receivable system, which results in a restart of the aging process in receivables. Promotional allowance manipulations. Sellers often provide rebates, incentives, or other credit to customers to purchase products in volume. These incentives can be in the form of volume discounts, reimbursement for special handling, co-advertising reimbursement, slotting fuss, etc. These incentives are based on sales going to be achieved in future, and to decide on the quantum of these incentives, certain estimates are to be made. These estimates can be manipulated or biased. When the company operates a promotional allowance scheme, there are chances of early recognitions of revenue or taking into consideration the cost of rebates or credits to be given to the buyer, resulting in inflated sales figures. Off-balance sheet entities and liabilities. It refers to a situation when companies borrow funds through off-balance sheet entities or special purpose entities so that these borrowed funds are not reflected on the company's balance sheet. However, some schemes are designed in a way to conceal debt and misstate liabilities on the balance sheet. Concealment of debt also has an impact on the income statement, as the concealed debt has to be serviced. Since liability is not on the balance sheet, therefore an interest is also charged to the income statement, thereby inflating the profits. Improper asset valuation capitalization of expenses. Financial statements are supposed to provide a true and fair picture of the state of affairs of the company. Improper treatment of expenses can lead to an increase in assets if the revenue expenses are treated as capital expenses, leading to inflated profits. Apart from this, ghost debtors scheme is also used to inflate the asset side and simultaneously siphon off the money from the company. Phony investment deals. These schemes are designed to inflate assets and earnings. They operate by deliberately overstating existing investments or creating fictitious investment accounts. Investments can also be intentionally misclarified, leading to improper recognition of gains or failure to recognize the losses. These schemes are also used to hide or defer losses arising from sales or permanent write-down from impairments. Adding back outstanding check to cash. In order to inflate the ending cash balance of an accounting period, outstanding checks may be added to cash balances, or the checks issued but not mailed or presented to the bank by the counterparty can also be added to the cash balance. Intercompany manipulations, unjustified consolidation entries. Nowadays, most of the companies operate through subsidiaries and other companies in which they have controlling stakes. In preparation of final accounts of holding company and subsidiary companies, the accounts have to be consolidated during the financial closing. Sometimes unjustified or fictitious consolidation entries are passed with limited accounting documentation or explanation. These schemes are operated to over or understate various balances or legitimize fictitious transactions. Related parties transactions and disclosure frauds. Related parties transactions are to be disclosed in a fair and transparent manner. This includes when related party transactions are done with an attempt to create fictitious transactions with the intent to increase reported revenues or assets. IT tools for fraud detection. Nowadays, most of the financial transactions are done through electronic devices, and authorization for these transactions is also more or less in electronic form. Forensic computing is the process of identifying, preserving, analyzing, and presenting digital evidence in a manner that is legally acceptable in the court of law. For this purpose, many IT tools and softwares are used. Some of the commonly used softwares are: Number 1. Helix. Helix is software based on Knoppix, a variant of Linux, which is used to acquire forensically sound images of hard drives and hard drive partitions of systems. Number 2. ACL Desktop. ACL Desktop, also known as Audit Command Language, is a tool to read and analyze various types of tiles scattered across multiple databases on different platforms. A unique feature of ACL is its ability to maintain data integrity, as its method of accessing the data is read-only access. Due to this feature, source data is never changed, altered, or deleted. Number 3. Ultra Block. Ultra Block is forensic write blocker hardware that prevents modification in data accessed for forensic accounting. Since the authenticity of data is very important in case of data being submitted to a court of law as evidence, use of ultra block hardware prevents the data from being modified or altered when the data is accessed and analyzed. And last is Password Kit. Password Kit Forensic is a tool to find all the password protected items on a computer system and gain access to these items using decryption and password recovery algorithms. Methods of fraud detection. There are two main methods used to detect fraud, which is supervised and unsupervised. Number 1. Supervised method. In this method, fraud detection is based on the dynamics of the previous frauds committed. This method makes use of prior data and information. The prior data and information, also called labeled information, consist of both genuine and fraudulent transactions. Based on prior data, models are constructed and trained to discriminate between genuine and fraudulent transactions. The basic assumption of these models is that the pattern of past frauds will persist for the present and future also. Since this method is based on the fraud structure of the past events, this method may not work due to overfitting to the training data set or unknown fraud types. The robustness of these methods also comes into question during extension, reutilization, and adaptation. For this system to be dynamically extendable and adjustable, new information must be fed into the model and retrained. Another drawback of this method is the uneven class size of legitimate and fraudulent transactions. The legitimate transactions outnumber the fraudulent transaction, and according to some studies, about 0.08% of observed transactions are fraudulent. Now, if this method classifies all fraudulent transactions as genuine, the error rate is going to be minuscule, which can be misleading. Number 2, unsupervised methods. These methods are based on the identification of outliers, which are detected through data mining techniques. Change in behavior and frequency of transaction is detected by suspicion scoring systems, which are based on the if-then type of outlier rules. These rules are based on experiential knowledge. When the pattern in data does not conform to the expected pattern or some anomalous data pattern is detected, it is an indication for further probe. The criteria to detect outliers are not fixed but may change for various reasons such as cost and efficiency. This method is similar to the human's cognitive decision process, enabling the auditors to understand the process and adjust the model if necessary. The results generated by the unsupervised method are not direct evidence of any fraud, but they merely tell that the flagged transactions do not fit into the data pattern, which may be either due to error or fraud. A normal financial audit confirms that the financial statements gave a true and fair picture of the state of affairs of the company and complied with all cable laws and accounting policies. During the course of the audit, auditors may come across transactions that are not normal in nature or are not backed with sufficient documentary evidence. To investigate these anomalies, forensic audit is done. Some of the techniques involved in forensic auditing to examine the frauds are: Number 1. Testing internal controls. Most organizations have internal controls in place, but there are certain weak links that are exploited by the fraudsters to commit fraud. A good initial forensic auditing technique is to understand and analyze the internal controls of an organization and find possible ways to circumvent the controls. This will give a fair idea to the auditor of the possible path of the fraudster. Number 2. Trend analysis. Most of the companies grow at a normal rate, and the various transactions required to accomplish the business task also exhibit a certain trend. Sudden spikes and troughs in the trend of these variables indicate something unusual and are worth investigating. During the forensic investigation, the auditor should review the organization's historical norms and analyze the outlier events in the context of historical norms. Number 3. Digital forensic examination. Digital forensic examination is one of the most important techniques for fraud investigation, as digital trails are difficult to cover up and manipulate. A close scrutiny of phone logs, official emails, accounting records, and company databases will uncover many hidden facts. A digital forensic examination is quite a compelling job and may require the assistance of computer and database specialists to assist the accounting and financial auditor. Number 4. Face-to-face interview. It is always a good idea to understand organizational dynamics and the process dynamics before undertaking a forensic audit. Face-to-face interview with the executives and managers is an effective tool to accomplish this. The information provided by them can direct the audit in the right direction. Most of them would have information about the event and have a perspective without being directly connected to the event or fraud. Number 5. Full financial audit. Before commencing forensic audit, it is important to conduct a full financial and accounting audit, which involves bank statement reconciliations, scrutiny of vendor contracts and payment, verification of sales and purchase, review of tax returns, and other filings with the public authorities. The findings of the financial audit give a lead to forensic auditors to identify suspicious transactions and trace them back to potential perpetrators. Number 6. Application of Benford's law. Benford's law is a mathematical tool to determine whether the variable under study, that is, suspicious transaction, is a case of unintentional error or fraud. The basic premise on which this law operates is that fabricated figures are an indicator of fraud and possess a different pattern from random figures which are generated from normal business transactions. Once a series of transactions is identified as suspected transactions, the leftmost digit of the figure is extracted of all transactions of that particular variable and summarized for the entire population. Next, the observed count percentage of the leftmost digit is calculated, and then Benford's set is applied to carry out a parametric test known as the Z-test, which is used to determine whether two population means are different when the variances are known and the sample size is large. Here the two population sets are Benford's percentage numbers for the first digit and observed numbers for the first digit. If the observed data confirms the percentage of Benford's law, it implies that the observed data is Benford's set and there is a 68% chance of a no error or fraud. Similar sets had been developed by Benford for 2, 3 and last digit as well. This method can be used for the analysis of credit card transactions, purchase orders, loan sanctioning authority to sanction loans below rupees 5 lakh, and any amount above that has to be referred to the circle office. Looking just below the approval threshold provides a potential to discover loan fraud. If the loan fraud is being perpetuated, it would be interesting to observe first figure 4 and first two figures 4, 9 and their repeated occurrence may signal potential fraud. Taking another example where any purchase above rupees 35,000 would require a purchase order. Here too, looking at the first figure 3 and the second figure 4 can reveal any anomalies, manipulations, or fraud involving this cutoff. Number 7. Theory of Relative Size Factor or RSF. The application of this theory can highlight unusual fluctuations in the data series under observation, and these unusual fluctuations then can be further analyzed to determine whether unusual fluctuation is genuine error or fraud. RSF is the ratio of the largest number to the second largest number in the data series. In practice, there exist certain limits for each entity, such as vendors, customers, and employees. These limits may be predefined based on historical data or may be derived from the available data. Based on these limits, stray cases that are way beyond the normal range shall be investigated further for the detection of anomalies or outliers. The values that fall outside the predefined range are suspected to be either fraud or error. These values need to be correlated with other variables to find the relationship and classify them as either error or fraud. Number 8. Computer-assisted auditing tools. These audit tools or softwares are designed to access data of audit significance from client's information system without depending on the client's accounting personnel. Since these are automated tools, the chances of data manipulation are minimal until and unless the information system itself is fed with manipulated data. These tools are capable of number 1. Testing details of transactions and balances. Number 2. Identifying inconsistencies or significant fluctuations. Number 3. Testing general as well as application controls of computer systems like data security and integrity. Number 4. Extracting sample data for audit verification. And number 5. Recalculation of calculations done by client computer. Number 9. Data analysis ratios. Financial ratios indicate the financial health of a company. Similarly, data analysis ratios for key numeric fields provide an indication of the fraud health by analyzing and identifying possible symptoms of fraud. Commonly used ratios are: number 1. The ratio of highest value to the lowest value. Number 2, the ratio of the highest to the second highest value. And number 3, the ratio of the current year to the previous year. The variables used in the ratio can be cost, production, the volume of sales, labor hours, expenses under various heads, etc. Benesch ratios. These ratios are used to distinguish between fraudulent financial reports and non-manipulated financial reports. The ratios used are: number 1, days sales in receivable index, that is, accounts receivable in time T over sales in time T divided by accounts receivable in time T minus 1 over sales in time T minus 1. In the case of manipulators, this index would be near 1.465, whereas in the case of non-manipulators, the mean index is going to be 1.031. Number 2, gross margin index. Gross margin in time T minus 1 over sales in time T minus 1 divided by gross margin in time T over sales in time T. In the case of manipulators, this index would be near 1.193, whereas in the case of non-manipulators, the mean index is going to be 1.014. Number 3, asset quality index. Current assets in time T plus net fixed assets in time T over total assets in time T divided by current assets in time T minus 1 plus net fixed assets in time T minus 1 over total assets in time T minus 1. In the case of manipulators, this index would be near 1.254, whereas in the case of non-manipulators, the mean index is going to be 1.039. Sales index. Sales in time T over sales in time T minus 1. In the case of manipulators, this index would be near 1.607, whereas in the case of non-manipulators, the mean index is going to be 1.134. Now let's summarize the unit. The last few decades have seen frauds of severe magnitude, resulting in loss of billions of dollars and loss of investors' confidence. The techniques used to get to the bottom of the fraud schemes, investigations, and preparation of evidence suitable for a court of law are collectively referred to as forensic accounting. Forensic accounting is a multidisciplinary field requiring the application of skills for many fields like accountancy, computers, and law. The fraud triangle specifies the conditions which, if present, can lead to fraud. The applications of forensic accounting are wide-ranging and are just not confined to companies. Corporate frauds have been extensively classified, and this classification is popularly referred to as fraud tree. Apart from the frauds happening in the normal functioning of the business, fraudulent financial statements is also a major fraud.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Uday Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.